Hello friends, today I am going to discuss if there is a huge loss in your equity portfolio, how to cope up. This is also happened to me, so I thought that what I am doing, if I share to my friends, they will also get benefited. See, first and foremost thing, what we all need to remember is this correction is a one-time event or singular event to Indian indices only? No, it's a global phenomenon. All over the world, the stock markets are significantly corrected. That is resulted in the loss in our equity portfolio. So, what is the best thing we need to do now is, I think I am going to explain in a few minutes now. If I take a step back and look at equity markets performance all over the world for the past 2 decades, you can notice that whenever there is a correction is there, it is followed by a big rally in the very next year itself. For example, take 1992. During that time, there is a singular event in India, that is because of Harshad Mehta, Big Bull. Because of that fraud, there was a significant correction. And then in 2000, we have another event, that is mainly because of this dot-com bubble and also this 9/11 incident and also Ketan Parekh. All these three together resulted in a significant correction in the market in 2000. Then 2008, I think most of you maybe remember that. That is mainly because of this subprime, these housing loans and bonds of financial institutions, Lehman Brothers collapse that resulted in a significant fall in the markets. So each of these significant falls are separated by 8 years. So I thought that there will be a correction even in 2016, but it's not happened that time. But in 2018, we have a small correction was there, not very significant. That is mainly because of growth concerns on Europe and as well as China. Now in 2020, we have a significant correction that is mainly because of COVID-19. So all over the world, the equity markets are significantly corrected. So each of this correction was followed by a huge rally. There was an excellent article written by Prashant Jain of HDFC Mutual Fund. I think it was written in Economic Times, and that article he clearly shown how equity markets performed after 2000 and 2008 market significant corrections. According to that graph and the fact presented by Prashant Jain, that equities have given a return of 12 to 16% in the next subsequent 5 years. So in my opinion, even this COVID 2020, the best case scenario in my opinion is by this December, I think everything will be settled down, and from 2021 onwards, I think we can see a new world. That's the best case scenario. In the worst case scenario, maybe it can extend to another 1 year. But afterwards, definitely the equity markets will give bumper returns to those who are, instead of timing the markets, who are stay in the market will be benefited. So, in the best case scenario, even after this 2020 COVID-19 deep correction, I am optimistic that the markets may give a very good return for the next 5-6 years, a double-digit return. And let's say in the worst case scenario, let us prepare for that as well. Let us say if this COVID-19 is a prolonged phenomena and resulting in negative losses, then the best course of action for all of us is just continue your systematic investment, whatever you have already given to your equity mutual funds, or even if you are buying a direct stocks also, please continue that one. But my suggestion is don't do any lump sum investment into these equity markets in a single go. That will be disastrous because the markets are really volatile during this part of time. Let us say if you have money of 1 lakh rupee which you wanted to invest into equity markets tomorrow, don't do it tomorrow itself, but I suggest to you make it into 5 equal parts put it into a liquid fund, and as and when there is a correction is there, and you go on add money to your portfolio, say 20,000 each time. Or it can be a time based, like every month or every quarter, or it can be based on the target returns you are expecting from your portfolio. Let us say if you are say one of the equity mutual fund corrected by 5%, that time you add 20,000, and again if there is a 5% correction, again you add the money. That is the ideal way of pumping money into your portfolio. A psychological study has shown that whenever there is a equities profits are there, one person can experience X times happiness. But if the equity markets give a loss, then the same person will experience 3x pain. So it is a very painful phenomenon, and we all need to prepare for this pain. All we are doing here is I wanted to get 3 to 4% higher return than a normal savings return coming on my investments. So I have taken an extra risk and invested my money into equity markets. So we all need to prepare for extra returns. There will be extra risk associated with that one. I will give you a simple example. Let us say if you invest your money, you are so much risk averse, and you put say some 10 lakh rupees in a 5 years fixed deposit in a bank. Do you go and check how much interest is accrued every month in bank or your online account? We don't do, right? Then why do you worry about looking at your equity portfolio every month and every day, every week, and that only results in anxiety? My suggestion is stop watching your portfolio for maybe 2-3 years. Give some time to your equity portfolio to give good returns in the long term. For example, even some of the best mutual funds have failed to give good return over a 5-year period. 5 years is quite a good time. For example, I used to tell my friends, if you don't need any money for 5 years, then that part of money you can invest into equities. If it is less than 5 years, don't invest. That was the suggestion. I just went through how my portfolio itself is performing. For example, last 5 years I invested in L&T Mid Cap Fund. 5 years back it is 5-star rated fund. Now it is 4-star, I believe, from Value Research. And it has given me a minus 3.5% of return for my 5 years systematic investment. That's very, very painful thing to digest. Even one of the best 5-star rated mutual fund, this Mirai Emerging Blue Chip, for the 5 years it has given a minuscule return of 3.5% to the investors. So my dear friends, what I want to suggest to you is even 5 years is a less time. If you need money for 5 years for some of the non-discretionary spending, for example, it can be a medical care, or it can be tuition fees, or any other essential item, better not to put into equities. If it is a non-discretionary spending, for example, like buying a sedan car, or house renovation, or a Switzerland second honeymoon trip, something like that, those kind of non-discretionary spendings, you can take risk actually. So be prepared for downside as well. That is my suggestion. Generally, this equity mutual fund returns I do not track, because those are for very long term. So I am not really worried about that. But I am also investing directly into the stocks. But this stock portfolio I will regularly monitor, because otherwise your losses will go at an exponential rate. My personal experience is, for example, Idea Cellular. Whatever the profit I made from my 24 stocks is wiped out by a single stock, that is Idea. So I will never forget the lesson learned from that single stock investment. So you need to be very careful which are the stocks you are choosing for your investment. So in case of equity portfolio, what is the best course of action for every one of us is frequently you review your portfolio, and we always have to invest on our winning horses. You should not invest on laggards. Generally what people will do is, let us say if a stock is corrected by 10%, you will be tempted to add more into that particular stock, and if it is corrected another 10%, we will go on add, and this phenomena is called as value trapping. You think that there is a significant value at lower levels, and you keep on add additional investment, and you will simply accumulate losses. So what is the best course of action is, now go through your portfolio. What are the laggards in your portfolio and what are the winning horses in your portfolio? Make a note, and then every raise in the market, this is called as a dead cat bounce. So every raise in the market, you get rid of these laggards and keep that money into a liquid mutual fund, and whenever there is a correction is there, and at that point of time bring back this money and add on your winning horses. So the only way you can make money is by betting on winning horses. Be careful with this value trap, and this phenomena also referred to as don't try to catch falling knives, so you will be bleeding for that. So another thing is, last month, when I checked my equity portfolio on Zerodha, I noticed 35% losses on my stock investments. That's huge loss. And one of my good friend, we together do the investments. He suggested that it hit the stop loss and you cannot continue your portfolio. It is better get rid of everything and then we will enter again at lower levels. According to his, this charts and graphs analysis shows that Nifty will be testing 6,000 levels. I was tempted to sell everything, but I felt, my gut says that okay, it is stupidity to sell everything now. See, whatever this 35% loss is actually a notional loss. If you sell and book those losses, then they will become real. This we all need to remember. I think God is in my favor, and I didn't sell that entire equity portfolio. Then what happened? Exactly 10 days back, it is nicely recovered actually. So my 35% loss has become only 23%. 12% in 20 days is phenomenal return. So if I have booked my notional losses, then I don't know, I will never ever again enter into equity markets. So you all need to remember, let us say if you wanted to book losses, what are the money you are going to get back, where you will invest that money is the key. So my suggestion is don't take any irrational decisions, or don't do anything hasty when you are in a bad mood. Think twice before whatever you are doing. So my humble advice to everyone is, I am not a certified financial advisor, but whatever I am suggesting is in your best interest. So if you have any doubt, slightest, talk to your financial advisor and take a better decision, and continue your equity investments, which is the only one going to give double-digit returns over long period. Thank you for watching this video.